Hansi Hansmann. When the first I heard about him, I heard he was kind of busy with 40 plus companies, trying to build those companies, so he was quite unreachable. A few years later, the situation is completely different. He's very busy now. He doesn't really have time because he's trying to sell those companies. So I understand it's a very easy and a very simple strategy. So what you do is you basically buy every good company in your country, right? And at some point you sell them at a higher price. Simple. So I think there's not much to see here, I think. So, but maybe there is more detail to that. So I'm very curious about. So give a warm round of applause to our super ranger from Vienna, Mr. Hansi Hansmann. One of the first questions we would love to understand is how you started. What was this business angel? How came the idea?
Well, let me first of all say thank you for the nice introduction. And I don't know whether I ever mentioned that, but I mean, I have some Hungarian roots. My mother is from Hungary. I'm this typical Viennese with a grandmother or mother from Hungary and grandfather from Czech Republic. That's more or less all Viennese people, something like that. So it's a really great pleasure for me to be here with you and to come to Budapest. The short-term answer why I became a business angel is because I was living and working my major part of my professional career outside of Austria, in Germany, UK, and 20 years in Spain. And when I was 59, some years ago, 8 years ago, I decided to come back to Vienna. And I sold all my companies that I had in Spain, and I realized I will be back in Vienna when I haven't lived for 20 years or 25 years, and I have nothing to do. So what will I do there? And it was kind of by accident that I was offered 2 angel investments, more or less at the same time. One was in Madrid, Buzu, the language learning company, and the other one was in Munich, Renesim, online jewelry, high price online jewelry. Both, I think, in both I did a ticket of 300,000 and said, I will try that and let's see what's coming out of that. And after 3 or 4 months, I realized this is exactly what I want to do. This is exactly my dream job after the whole career I had. So over the next 36 months, I did 1 angel investment per month with quite big tickets, because I'm always kind of the person all in. I like that. If I look back now, what I have done in my life, in my professional career, I have been doing more or less everything. That means I was an employee in a small company, I was an employee in a huge corporate. Then in Spain, I was CEO of a pharmaceutical company with 800, 900 people reporting to me. I did a management, founded my own company. And my own company, when I started, had 400 employees. Then I sold that company, then I invested. I was kind of this financial investor, you know. You invest money and then you try to get the CEO working for you, not a business angel. And when I finally became a business angel, I realized that my whole professional career was to prepare me for that. That's the climax of my professional life. I've never done something more exciting, more challenging, more rewarding than being a business angel. That's really what I love to do. And that, by the way, is the only thing I missed in the first panel. I think if you want to become a business angel, you have to love that. You have to enjoy that. And that's the main difference between investing money in a company and hoping that it's doing well and maybe helping a bit, or really being part of that, loving the people, loving the business, and not taking care, not even caring about the money once you have invested it. If you invest money, whether it's 5,000, it's 50,000 or 500,000, you have not invested 500,000. You have a stake in a company, and you have to take care that this stake in the company is more valuable with time. That's exactly what you're doing as a business angel.
Somewhere back in time in Vienna, we were talking about what is happening in the Hungarian scene, and we just raised the topic that there are investors asking for 51%, and you said, hey, they are not business angels. So what makes a good business angel? How do you define business angels?
I mean, I think before you define what is a business angel, you have to define what is a startup, because that's very much related, business angel and startup. When we talk about startups today, we talk normally about digital startups. There are also other startups, but most of the time we talk about digital startups. That means that if founders find a new way of doing business, if they can solve a problem a different way with a lot of innovation, in the ideal case, disruptive, so that they completely replace another business model, and if this business is also scalable, then we talk about a startup. This is, and we heard that in the first panel, this is really hard to do. That's one of the most difficult things you can do in life. It's difficult to be an entrepreneur, but it's much more difficult to be a startup founder, because you're an entrepreneur and then you're doing something that nobody before has done. So you have to invent a lot of things, and inventing a lot of things mean you try out something and you fail, you try out and you fail, you try 100 times, 500 times, 1,000 times, and once you may say, oh, that's working, so let's go into that direction. But what I want to say with that is that you have many more frustrations than successes all the time. So this is really, really difficult. We have also heard that in the first panel. You can't see out of the crap. I think Sultan said that. That's really true. And a business angel is helping these startup founders. How is he helping them? He's giving them money, but not always. They are business angels. They don't even give money, and they can be business angels. But it's always good to put money if you get equity in a company, and not just because for working and for helping. So you have to help these founders in what they are lacking. And normally in digital companies, these are young founders. Young founders, why? Because the younger they are, the more digital they are. I mean, they are educated, and they live with the digital, they live the digital life away I cannot even dream upon. I mean, they know about that just by, I mean, okay. Just watch them, how they are writing messages on a smartphone, young people. They do that in a fourth or fifth of the time I need for that. So these are really good people. They are passionate about what they are doing. They are hopefully full of energy. They have a lot of characteristics, and they know a lot that I do not, but they have not experienced. How can they? I mean, if they are 20, 25, 28, they cannot be experienced people. And that is what I, as a business angel, have. I've seen a lot of things in my life. I have founded companies, I have sold companies, I have built up business models, I have hired a lot of people, I have fired a lot of people, I have been selling your products, I have been doing B2C sales and B2B sales. All these things the founders never have done. For example, B2B sales is a good example. Digital founders normally are quite good in B2C. Why? Because they are sitting behind their PC and they can control the world from their PC. You know, you're sending out, you're doing some ads, and you're getting traffic in, and you're getting this funnel, and you're converting that in different phases, and finally you have 100% or 2% or whatever percentage of people that you convert in paying customers. There's no need that you get out of your office to do that. So they are really good in that. They are much better than anybody else in that. But if you invest, for example, in B2B business, what does that mean? You have to go out and sell to a corporate. And that's a total different animal, you know. And young people, I've seen it very often, they have built a wonderful product, and you see, wow, this is a product with real big potential. And then you expect that these people go out and sell it. They have no clue about it. They cannot sell that, because B2B sales is totally different. So that's my job as a business angel, to find the right people to help them, maybe to teach them a bit. And then there's one thing, I have even 2 cases where the founders of a B2B companies were great sellers. and they sold with the founder bonus. It's easier to sell with the founder bonus if you go to corporates and sell your product, and they did really nice deals. But that's just a small percentage of the business, because then you have to scale up the business, and it's one thing if you are a good seller, and a total different thing if you need 20 or 30 or 50 people, a sales force of experienced people and how to run them. So that's just one example where lack of experience will make everything more costly, because finally it's that. Every failure they do, every mistake they do costs money. And I, as a business angel, or whoever is a business angel, can help them to spend less money, because we can avoid mistakes and we can avoid more frustrations than necessary. They have more than enough frustrations in the normal things, in the normal way they are doing, but we can help them to have a level of frustration that is you can kind of live with that. So that's what a business angel is doing.
When you have to make up your mind, do you remember some good and bad examples when you made a good decision, or when you really sort of made a bad one? And what were the characteristics of the good ones and the bad ones?
You know, there are this called golden rule when you buy real estate. The 3 golden rules when buying real estate is 1 location, 2 location, 3 location. The 3 golden rules when you invest in a company is 1 team, 2 team, and 3 team. So I personally apply 3 filters for the team, and only if the team passes the 3 filters, I think more detailed about the business model or the product they have. And the first and very important filter for me is, do I like the people? And do I have the feeling that they like me? That's just so important, because coming back to what I said before, all this frustration, all this crisis, I mean, I haven't invested in the company, well, maybe with one exception, that never had a real deep crisis, or 2 or 3 or 4 crises. Near-death experience, like we call it in the startup world. I mean, if you go through that, this is really kind of personal building, and you are very close to the people, and it's always much better to do that with people you like, to help them out of that, than with people you don't like. Just as simple as that. And liking means more than just liking. Liking means kind of the mindset has to be a little bit in the same direction. So it's very much about the mindset I have with the founders. And I also, by the way, tell them always, if you are looking for co-founders, also check the mindset you have within the team, because one of the major reasons for failure in startups, in my experience, is a founder clash. So the second filter is there a team? I never ever invest. I mean, I can say that, but I have done exceptions. But the rule is never ever invest in one man or one woman shows. When I did it, because that was just a super founder or a super female founder or whatever, 1 or 2 or 3 years later, I paid the invoice for that. There's always to pay the invoice, always. So it's a team, and you need a clear leader in the team. That's also a very important thing. It's not even good if they are 3 leaders, believe me. If you have 3 big egos, they will never form a team. You have to have one person, whether it's a man or a woman, that really knows where to go, and the others follow. And the third filter is there the kind of the characteristics that they need for the business. After that long introduction, I'm going to answer your that's a question. So whenever I followed my rules to go through these 3 filters, and all the 3 filters were fine and checked, it was kind of a successful investment. And whenever I did an exception, because I thought, wow, I mean, it's just worth to do that, I had problems afterwards. Like in any company, you need always a person who knows the technical things, a person who knows the product things, and a person who knows how to sell, very important. And if possible, not necessarily in the very beginning, somebody who knows about numbers. And even in digital companies, you need these characteristics. So and this can be distributed between 2 people or 3 or maximum 4, and never invest in startups with more than 4 people. Why? Because if they are 4, they start with 25% each, and that's already not a big percentage. And if you think about 2, 3, 4 funding rounds, I mean, very easily they can go down to percentages that are not attractive for them. It has advantages to have 4 founders. Rantastic, for example, one of my biggest successes, had 4 founders, but they never needed money, so then it's good. So the only investor there, I was the only investor there. And if you have 4 people, 4 founders working, you know, a founder working is the best thing you can have, because he doesn't get a big salary normally, and that's the game, because his interest is to add value to his stake, and he works more than 40 hours. So if you have more of these people, that's good for the company. On the other hand, they have just smaller percentages each, the more they are.
If those 3 checks are okay, then your decision is made, or there is still some due diligence going on with respect to the product?
Well, obviously, it's nice to have a sexy product, okay? But I have invested in teams where I did not believe in the product or the business model. I mean, there's a very, very good example for that. One of my investments was Spock, the flea market app. Some of you might know that. When I invested in the team and they explained me the 3rd time their product, even after the 3rd time, I didn't really understand what they wanted to do. And that's a problem, because I want to understand the problem they are solving. But I thought the team is so good, I really like them, I will invest. And they spent, I would say, 80% of the whole money in that first product for more than 1 year, and that completely failed. If there are 500 freaks out there and they always tell you, wow, what a great product, that's exactly what I was looking for, and you get these kind of messages, you are motivated to continue. But if after 5 or 6 months you only have the same 500 freaks and not others, you know that you have done a product for freaks, and that's not a big market. So I stopped to finance, and they told me, and the co-investor had a co-investor in that case, they would need a little bit of money and 4 weeks because they have a great idea. That was a flea market app. And we gave them the money, and we gave them the 4 weeks, and we sold the company for 200 million.
We just showed the EBAN statistics about the average return on angel investments are cash on cash 2.6. So if you can share, for instance, in case of Runtastic or Spock, roughly, or an average on your portfolio return, how does that look like? It's 2.6, it's better.
In case of Runtastic, it wasn't such a huge multiple. It was for me, it was a multiple of 16. That's not that big.
16.
16.
Yeah.
It was 16 because
still.
I invested late in Runtastic. It was kind of where I normally do a Series A. And I was happy that they accepted me to invest, because they didn't need an investor. They just wanted me to have on board, and they needed some money. That was the reason why I could invest into that company. And I invested more than 1 million within 10 minutes of time I had. And that was a 16 times multiple. In case of Spock, it was 35. And in case of my other big exit, I can't say that really, because the numbers were not disclosed. It was also a very good multiple. My sugar was sold last year to Roche, and it was the biggest exit in e-health so far in the world.
Well, sounds good, and congratulations to that. I think at HUNBAN we are eager to see such exits. Coming back to an EBAN study, there are several, let's say, problems discovered by an EBAN study regarding angel investments, and angels say that sometimes they can't invest because the startups are taking VC money, and the main problem is valuation. So VCs with a lot of EIF, etc., money, they can offer higher valuations sometimes than startups. Of course, in nowadays, I assume that Hansi can easily find a projects to invest. But if there is a HUNBAN member who has not so good track record, and there is one VC offering better valuation, what's your recommendation? Should the angel match the valuation? Should they somehow explain and pitch why it makes sense to choose the angel with all the smart money elements what you described?
Well, normally what you compare is not just the valuation. There are more things to compare. The terms of the term sheet, that's why it's called term sheet, can be totally different. As a business angel, for example, I never take liquidation preference. VCs always do. I mean, they invest money from other people, not their own money. They have to protect that, and they have different rules, and they have to follow different rules. So they normally have at least one time liquidation preference. I've seen worse cases with 2, 3, 4, 5 times. I mean, it's easy to offer, for example, a pre-money valuation. Instead of 5 million, you can offer 15 million, but have a 4 times liquidation preference. Founders tend to see only the 15 million in that case, so that you have to really compare the right things. Or a downside protection. That means if you do a next round at a lower valuation, if you're a business angel, I mean, that's a pity. That's your problem. If you're a VC, I mean, it's not really a good situation for you, but at least you get compensated for the valuation, and you get the share. So if you would have invested at a lower valuation, so there are many more things to think about. But the most important thing to think about is that VCs have a different model. If you want a VC to invest in your company as a founder, you really should go into detail in the webpage of that VC and look what they are looking for, what they want, what kind of markets they want, how much money is, and which stage is the VC. Do they have only 2 years left with that VC, or have they 5 or 6 or 7 years left? All these things are really influencing your startup. And VCs have, I don't know any VC who would invest in a company if he can't see a realistic possibility of multiplying his money by 10. And you have to know about that. If you are a founder and have, for example, a business angel in a very early stage, and then looking for the next funding round, and maybe you get even a higher valuation with more business angels, take care with these valuations, because if your valuation goes up too fast, you cannot be any longer a VC case. On the other hand, and I would say the Austrian startup scene is a bit more developed compared to the Hungarian. In my own whole portfolio of 45 companies, I would say there are 3 cases where I would say 3, maybe 4, where I would say they are VC ready or VC cases. You not necessarily need a VC case. A VC needs to see the potential of a fund returner in any investment he does. And that means if he puts in the money, he will force you to grow the company, to scale up the company, and if it works out well, it's great for everybody. But it works out well in 1 or 2 of 10 cases, even with good companies. And the others maybe die because of that. But they would not have died if they would have taken business angel money or from high net worth individuals and growing the company a little bit slower and not with VC money. So there are not so many VC cases as we all think, at least not in our region. There are some, but they are much fewer than we might think. A VC always has a kind of stop-loss strategy. When he sees that certain criteria is not fulfilled, he is very clear. Let's say in the next 4 months, these and these milestones are not achieved. You just stop investing. Go and do what you want, not with my money. An angel who has a normally closer relationship with the founders would maybe give in more money at that time, and maybe it works out and maybe not.
I had you on mind that you're more of a lonely investor, but I might get this wrong. So what is your stand on investing with other angels?
I would say that's a very personal approach I have. I went in as an investor in the first round, always alone. I did the full first round, whether 300, 500,000 or whatever, because I focused very much in the first 12 to 15 months on my relation with the founders, on finding out how they work together as a team, obviously on trying to improve the business model and all these things, and bringing some structure into the company. And maybe if I thought the company would need more money, I just was putting in that money. So I had a lot of flexibility. I do not have this flexibility if I have co-investors. If I have co-investors, I don't have the same feeling that I'm responsible for that. So it's shared responsibility, and I tend to do a step back. So that's just my personal approach. I cannot say whether this is working for everybody. It worked quite well for me. In the next round, in the next funding round, where I normally do not participate, because I have already a big share, which is normally as big as an average founder share, but I'm in the boat with the founders, and we together look for the next investor, and I get diluted like they. I really try to avoid a situation where my share is higher than the founder share, because I don't want to have them the feeling that they work for me. But I want to have them the feeling that we are together in a boat, that they have their roles. Their role is operational, and my role is more strategic and helping and everything.
What is a healthy percentage to give to an angel, roughly?
I cannot say there's a healthy percentage to give to an angel. There is a healthy percentage which you give away in one round. That is between 15 and 20%. And one round means you are financed for at least 12 months, sometimes longer, sometimes a little bit shorter, depending what you're doing. And whether this 15 or 20% you give away to one business angel or to 5, that's a different thing. But not give away more than, I would say, maximum 25% if it's a real attractive and big big amount of money.
You mentioned that you're helping your startups to raise the next round. So one part of the question is how do you do that? The second part is how do you have time to on one hand work on your deal flow, on the other hand work on your investor relations. So it's a heavy duty thing.
I don't have to work on my deal flow. I never had to work on my deal flow. The deal flow was just coming. I can say that I probably get every interesting startup in Austria and most of German startups on my desk. But I stopped investing, very important message, I stopped investing beginning of last year, so no new investments.
You want to enjoy your beer this tonight.
I mean, just to develop my current portfolio is really a huge workload. As I said before, just half of them are lead investments. I mean, it's still a big number. That are lead investments, and I take care mostly of my lead investments, because in the co-investments I assume that there is somebody I know and I trust who is a business angel who does the work I'm doing in my companies. Where I'm lead investor, I take care of all financing rounds and of all exit participations. I don't go out before the founders go out, if it's possible. I have done that in all my 3 big exits, in other smaller exits. Why? Because I mentioned before that one major reason why startups fail is a founder clash. The second major reason why startups fail, promising startups that in general are good startups, they also can fail. They fail because they don't get the next funding round in time. And the reason for that very often is that founders are not good in fundraising. They have not learned that. Why should they be able to do that? And even if after, let's say, these 6 months, what you normally count that it takes from the day you say, okay, that's a good startup, we have reached our milestones, we have a really good forecast, we now go out and go for the next round, it takes you 6 months or 6 months. Whether it's private round, whether it's venture capital, it's always that kind of things. If the founders are doing that, and even if they are successful, I mean, that we're not talking about a big company, we're talking a company between 5 and 20 people or whatever. So the major managing resources of that company are dedicated to something that is not the core business, and that's a big failure. That's a big failure. I really think that if founders, the people that are responsible for the product, normally the product people or the marketing people, are dedicating 70-80% of their time to do fundraising, that's a big mistake. Because even if they get the money after 6 months, the company has lost 3, 4, 5 months, and sometimes is in a situation where there's no way that they can get on track again. So in my companies where I'm a lead investor, they have not to care about money. I take care of the money. So we together decide that we need a next round. We talk about how much and what kind of investors, whether it's a VC, whether it's a strategic investor, whether it's high net worth individual or whatever. And then I approach the right people from my network. In the meantime, I have a huge network of people who really want to invest where I'm invested. And I find the right people. And I don't take everybody. It's not just the money. I have to also like my investors. If I don't like them, they will not come into my company.
How do you, I mean, we touched earlier on how you how angels should work with a company. So what is your approach in terms of frequency, meetings, reporting? So how does it work?
Every company does a reporting month by month. In the beginning, it's a very, very simple thing. And I would say during the first 2 years or 2.5 years, it's kind of a one-pager. Even if there are no revenues, there's always something to report. Whether it's traffic, whether it's the progress with the product, whether it's 3 or 4 lines, this is what happened this month, and this is what we are going to do next month. I want to see that written down on a one-pager. So that's a discipline which sometimes a little bit more difficult to introduce into the companies, but I really want that. And before I go out and look for the next funding round, so where the company, let's say, has a valuation of 4, 5, 6, 7, 8 million, I mean, if you invest in a company 1 million euros at a 6, 7, 8 million valuation, you can expect that there is some kind of really good reporting already. And we do that reporting. So before this reporting is not really there, before some criteria is not fulfilled, I don't go out and look for new money. Because it's just easier to find that then. I know that process, I've done it. I've done around 75 funding rounds in the last several years.
We will have very soon a pitching session. So do you think these startup pitches are a good first step before an investment? So a good conversation starter. Maybe in your past, did you find good startups at startup pitch events?
I would recommend any startup to have prepared, let's say, a 30-second pitch, a 2-minute pitch, and a 5-minute pitch, but prepared a way that it's really professional, coming to the point. And if you wake up that guy at 3 o'clock in the morning and tell him, do me the 2-minute pitch, that has to go like that. Because you don't know how many opportunities you have to talk to people, to talk to potential investors. And if you talk to a potential investor, you have to have the right pitch. And the pitch is something that is, from my point of view, very easy. I mean, sometimes when I'm on stage, and many times then there are a lot of people coming to me and wanting to pitch me. And when somebody starts with, you know, last year I met my friend and we had this idea coming together, I say, okay, next one, come back when you have prepared your pitch. You can really, I think you can really explain, tease a business model in 30 to 50 seconds. It's just describe the problem you're solving. You know, there's no startup if you don't solve a problem. You always have to solve a problem. If you don't solve a problem, don't even think about a startup. How do you solve the problem? Where is it better than your competitor? Who are your competitors and how you're going to monetize that? I mean, you can say that in 20 seconds if you want, with any startup. Even if it's a very complicated technological startup, if you abstract it down to that, it's very easy to explain that. So it's really important to have a good pitch. what you should not do as an investor, to judge the quality of the startup just by the pitch. The pitch is something that you get interest, to look closer to the people and look closer into details. Because yes, it's correct. I have seen I've seen many pitches, and there were people pitching, they were really great pitching, and when I thought a little bit more in detail, I said, what a bullshit, that company. But the pitcher was really great, you know. I have seen that. And I've also seen it the other way around. Really cool business models, and somebody there on stage not able to explain it to the people, so no one understood what important problem they solved. So the pitch is important, it's really important. Have somebody in the company who is able to do that is also important. So any company that has nobody in the founder team who is able to do a good pitch has a problem, because there are so many opportunities where you have to pitch. You also have to pitch to investors. Pitching means selling finally. And selling means convincing. So there has to be somebody in the company who is able to go out there and sell the company to investors, to the product to customers or whatever. You need that person as a founder. Equally like you need a tech person if it's a digital company, or somebody in a later stage who knows about numbers. But don't judge the company just because of the pitch.
Any questions from the audience? We have one question, so make it good.
Thank you, Hansi. At the beginning, you talked about teams, and there are great teams that might not be complete. So what is your approach to actually complete a team where you see someone missing?
I have a very clear approach on that. If the team is not full, I tell them go back and find a co-founder and come back to me then. I'm not going to look for a co-founder. That's their job. We will see a huge amount of startups in the next years, because I think personally there's nothing better than a startup to try out new creative ideas that does not work in the corporate environment. And I also think that most of these startups finally will end up within the corporates as a feature. Very few startups will have their own sustainable business model at the end. There will be some, correct, but very fewer than we think. But there will be huge amount of startups. And all these startups have to be financed, and we do not have enough resources. And with resources, I don't mean money. There's money more than enough. There's a huge amount of liquidity in all markets. But resources in terms of infrastructure, maybe the ICO in a more regulated form is a way of doing that. An IPO could be, ICO and IPO are quite similar things. Just the one is regulated and the other not. But if both are regulated, then that's maybe the solution. I personally think that the role of venture capitalists will go down in the future. I think that business angel investment and groups of business angels where the know-how and the experience is grouped together will play an even more important role in the future.
That's a fantastic closing word. It's been truly wonderful. I think we are so pleased that you've been here. It's been wonderful. And there is such a thing. We created an honorary member of the Hungarian Business Angel Network, which will be very, very extremely valuable in 3.5 years.
Yeah.